Welcome to Money 911, your ultimate guide to navigating the intricate world of finances and taxes. I'm your host, Kris Miller, and today we're diving deep into the realm of business tax deductions. But fear not, we're not here to overwhelm you with jargon and complexity. Instead, we're here to simplify the process, empower you with knowledge, and help you make the most out of your financial situation. Get ready to transform your understanding of taxes and finances as we bring you insights from our esteemed guest, Mark Myers. All right, Mark, fabulous to have you here. And, you've helped so many different business owners reduce their tax bills significantly. And maybe you could share with the listeners, because everybody's got their ears perked up when you talk about taxes, some misconceptions about business tax deductions that you've encountered in your years of experience.
Well, it's a fantastic first question, Kris. Thanks for
Thank
jumping
you.
right in and
Right, just
get a
jump.
roll up our sleeves here.
Right. Yeah, I'm not warming up at all. It's like we're on.
I love it. I love it. Thank you. Thank you for that question and for having me on the show and on the
Sure.
podcast. I think with business owners, a lot of times it's just they meet with their CPAs sometimes once a year. And it's always let's see what you did last year. Are you sure you got all those expenses and we're not missing anything? Okay, here's your tax liability and sign here. That's not every interaction with their tax professionals like that, but I'd say that is fairly common, more common than we'd like to think.
Right.
So really, I think where we're going with this is, my work in business is not to replace a business owner's trusted CPA or even their financial advisory team or tax attorneys. It really is to work alongside them and say, if you have not been doing forward-looking tax planning, right? What are we doing for 2024 in quarter one or quarter two of 2024? Not in quarter one of 2025 or quarter four of 2024. Is there anything that we can buy that we need or not need to reduce our tax liability, right? Let's spend $1 on some capital equipment that's going to save us 45 cents if you're in California, or 50 cents at the highest tax brackets, but you're still spending $1, save 50 cents. So really that conversation, Kris, is about let's start looking at forward-thinking planning, and let's make sure that there's 75,000 pages of tax code. Let's make sure that we're looking for the coupons that are appropriate to you. And that's all we do at TaxWise Partners. All we do is search, put our minder's hat on, look for the coupons, and essentially vet the coupons. We have CPAs, tax attorneys that are independent that help us go through and make sure that these are viable, or they're being implemented the right way. We put them in our toolbox, and then when we're brought into a situation, we ask a few questions, get the facts, and say, well, hey, did you know about these 4 coupons that you're not currently using? Let me share them with you, and let's look at the economic benefits. And of course, if you like the economic benefits and you like how they work, let's cut these coupons, right? But unfortunately, the IRS doesn't send out a weekly flyer that says, here's your weekly coupons for tax savings.
Right. I never even heard the phrase coupons before. It was like, oh, give me some of those, right? Yeah. Well, most entrepreneurs, they struggle to maximize their deductions by staying current with tax laws, and they're behind the scenes in the middle of the night changing everything. But just simplifying it, like you said, 75,000 pages of tax laws. Do you think you're missing something, right? So, what strategies do you recommend for small and medium-sized businesses to effectively navigate this challenge?
Great question. There's quite a few, but when we start from the ground up, we always look at what can you do from the ground up that, starts to add up. It's got to make sense. And if it makes sense, hopefully it makes dollars.
Right.
So for small business owners that might not be producing a tremendous amount of revenue yet, we always look at entity structure. We always look at how are you receiving that income. And a lot of times, some business owners are sole proprietor when they first start, or maybe they're just an LLC, disregarded. And we look at, maybe there's a benefit for you to become a subchapter S.
A what?
A lot of times sometimes there's a benefit for them to become a subchapter S corporation.
Mm-hmm.
So sometimes we'll look at that and say, well, they'll say, why should we be a subchapter S? Well, maybe we can justify a salary that's lower than what you're taking in profit in your LLC. Therefore, we can reduce your employment tax, right? Because right now in your LLC, you're paying employment tax on every single dollar you earn in profit up to around $170,000. So maybe we can actually reduce your employment tax because you can take a viable salary for less than $178,000. Other things like Augusta rule, people have heard about it. Oh, I've heard that you can rent your house and you can take that income tax free. Well, yeah, you absolutely can. It's been happening for 60 plus years. And you don't have to have a stranger in your house, because guess what? If your LLC that you turn into a subchapter S corporation, it is another person. Legally speaking, your S corporation is another person. Therefore, you can rent your home to your S corp, a third party, up to a certain number of days per year. And it's an expense to your S corp, and it is not income that's taxable to you as long as you follow the rules. So these little things, I call it the chip shot. The reason why I call it the chip shot, Kris, is a lot of people have heard of it. It started in a little town called Augusta, Georgia, about 60 years ago, when they realized that, wow, there's a lot of people that are converging on this small town to have see who gets the green jacket. And they could rent their homes out to corporations coming in town that wanted to snooze their high-class clients for beaucoup of money and go on a trip for a few days and make a lot of money on renting their homes to other people or corporations that wanted to be close to the course. These are affluent people, and they partnered up with their other affluent friends that were in Congress and House, and they said, what can we do? We're getting this income, and we don't have a lot of deductions for our primary residence. And they came up with this little tax code, 163 and 280A, and it said, you can actually rent your home to a third party up to a certain number of days per year, and you don't have to pay income tax on that.
Wow. So does the home have to be in the name of the S corp, or is it as a person's name or in their trust?
So great question. The home is essentially Kris Miller's home, right? It's your home, you own it, and you have decided that you're going to allow for a third party to rent it. Okay. That third party just happens to be an S corp or a C corp or a 1065 partnership, right? Any of those three entity structures will qualify because they are considered a individual in the eyes of the law. So because your entity is a third party and it's an independent individual, you have the legal right to rent it to that individual, your company. And of course, now your company has a deduction because they have the right to rent third-party space for the purpose of board of directors meetings or fiscal responsibility meetings or human resources meetings or accounting or employment decisions. It doesn't matter, right? Whatever it is that you need to do to move your business forward. So now we just need to figure out how to do this the right way and what it's worth. What is it worth to your business to have these meetings, and what can you rightfully charge these third parties to use your home for those meetings?
Interesting. And does that include nonprofits?
Absolutely.
Whoa.
Absolutely. Now, of course, nonprofits, they don't have a tax issue, but the good news is whoever's receiving the income that owns the home, they may have the tax issue, and they're the ones that's getting to receive this. They're the ones that receive the rental income. And so long as you follow the rules, you're not paying taxes on that rental income. You just have to follow the rules, and you can't do it over a specific number of days per year. You have to make sure that you're following the guidelines.
Right.
So
it's really not full time. What's the sorry? What's the time?
I was just going to say those are those are some little basics ones. Those are like
Mhm.
when I'm talking to someone that has, $5 million of income, after they've taken all their expenses and done everything they can think of, they're saying, great, Mark, I'm really happy I can rent my home to my business for $40,000 a year, but what are we going to do with the other $4,960,000 of taxable income? So that's when we move on to the other coupons, right? But those are the great ones for the small business owners that just need some extra working capital.
And how many days are you allowed to do that out of the
14,
360? How many?
14 days, 14 days.
14 days you can rent it out for out of a year, right?
That's correct.
Okay. Okay. And so we were talking earlier before we started this show, and it was very interesting. You were talking about how you can use solar to reduce your taxes, but it's not necessarily putting a solar panel on your house. So that perked my attention. Maybe you could share with everybody what that's about.
Absolutely. And Kris, this one would be for an income of any size.
Okay.
So, and it doesn't have to be a business owner. It could be a W-2 earner. It can be a Silicon Valley executive or engineer that earns $500,000 of salary, and they've got $400,000 of bonuses, and they've got $600,000 worth of restricted stock units that vest every year that they're paying taxes on. They're paying taxes on 7+ figures, and they're W-2 earners, so they have nothing that they can do to defend themselves from their tax liability. So obviously a business owner that's the same, we can still do the same thing, but the solar is great. And the reason why solar is great is because the federal government wants the private sector, me and you, Kris, and all of our listeners, your listeners, they want us to expand the renewable energy grid. They want us to have solar on the roofs of every business, every home, every carport in America. That is the goal. That's why they say if you purchase solar, most people think it has to be on their own home. But let's just say you own solar on the roof of a grocery store or a public high school or a private high school or a church or a synagogue or a gas station or a community farm. Doesn't matter. I mean, obviously these are all commercial buildings or commercial businesses. Well, they'll give you a tax credit. So for every $1 of solar that you purchase, according to the Inflation Reduction Act, that the 2021 Inflation Reduction Act that came out in late 2022, the federal government said, we want you to buy solar so much that we're willing to give you 30%, 40%, 50%, possibly even 60% tax credit for every $1 of solar you purchase on the roof of your home or a third party, a business, right? And that's pretty nice when you spend $1 and you get 60 cents of a tax credit, because 60 cents of a tax credit offsets 60 cents of tax liability.
Cool.
You also, the interesting thing with solar is you also get depreciation. People that understand real estate realize that, wow, I like it. I can take my piece of real estate and I can take the depreciation against the net income and it offsets my taxes. Well, solar does the same thing, but it actually does it a lot better because a solar depreciation schedule is only 6 years. A real estate depreciation schedule is 29.5 if it's residential and 39+ if it's commercial. So now you have all this depreciation from the solar you purchased, and you can take it in a short 6-year window. And guess what? There's bonus depreciation that the federal government likes to give out. You can take most of your federal depreciation in the very first year. So now what we do is we say, Mr. or Mrs. High Income Earner paying a lot of taxes, would you like to send $1 to the federal and state authorities and let them spend it the way they want, which may not benefit as much as you want, or take them up on their offer to expand the renewable energy grid? And if you want to take them up on their offer, we can literally, in California, we can have you spend 55 cents in your solar business, and it's going to cover $1 of tax. So do you want to spend $1 of tax, or do you want to buy 55 cents? You want to spend 55 cents buying solar in your solar business, because we're setting them up with a little solar business. just like if they were purchasing real estate, they'd have a little LLC and they purchase real estate in their LLC. We're setting them up with a solar business in their LLC, and they're purchasing solar in their LLC. Why? Because for every 60 cents or say 55 cents in California, because Florida's a little bit different, or Nevada or Washington State or Tennessee or Texas, they don't have to pay state tax. They don't have that beautiful sunshine tax California has. But they can say, well, great, I'd rather spend 55 cents in my solar business to offset $1 of my total tax. Why total tax? Because as long as you materially participate in your solar business, according to the IRS, 100 hours of material participation, and guess what? All the depreciation and tax credit that you earn in that tax business can go against any of your income. Your business income, your W-2 income, your RSU vesting income, it doesn't matter. So that's where solar gets powerful. And I don't want to forget cash flow. You also get positive cash flow from it as well.
Oh, that's definitely something to remember. That is interesting. And which leads me to think about long-term capital gains, right? Including real estate or whatever. Maybe unroll that one too.
Yes. Oh, I love the capital gains question. So Kris, let's just say you have an asset that you purchased 2 years ago, 5 years ago, 20 years ago, right? And it has appreciated quite a bit. And you're ready to release it to the world. You want someone else to own it, not you. Whether it's a business or a piece of real estate or private equity or a cryptocurrency or a piece of artwork, it doesn't matter what it is. Well, if you sell that asset and the constructive receipt or the assignment of income is in Kris Miller's name, right? Or maybe you're selling a business that's a structure, but you own the business. So technically, when you sign the purchase agreement and that seller says, great, I'm buying your business, or I'm buying it from you, Kris, well, you have to pay the long-term capital gains tax, right? The IRS says, great, I see you just sold that asset. Well, what was your cost basis? Okay, my cost basis was $100,000. What did you sell it for? I sold it for $2 million. Okay, pay us taxes on $1.9 million. And in California, that's 37% of $1.9 million is going to be bye-bye. So I say to you, Kris, please tell me before you're going to sell an asset, because if we can adjust your sale prior to, then you don't need to take assignment of income. And if you don't take assignment of income, you don't have a tax liability. So what if we were to structure a trust for you prior to your sale that you're going to allocate whatever amount of equity that you want of that asset you're selling into this trust, and then we're going to assign the value of that asset in the trust as the same amount as the sales price. So now when the sale happens, the trust is selling the asset, the intermediary, not you, so you don't take the money, so you don't have a tax bill, but the trust is selling the asset at the same price as the purchase price. So there's no net tax event to the trust. Well, now you don't have a tax bill. So how do you get the money out of the trust? Well, you have a lot of different ways you can get the money out of the trust, but you completely control that money. Cool thing is you can invest it and reinvest it, have earnings, invest it again, have more earnings, and you pay no taxes on those earnings. The only time you pay taxes is when you take money out of that trust, and we can make that tax efficient too. Sounds kind of like some familiar, right? It sounds kind of like a 401k or something, right? It's not a 401k, but it works like one, and you don't have all the rules around it. There's no minimum required withdrawals at age 73. When you pass away, your kids aren't, punished with this huge burden because they have to pay all the taxes that you didn't pay on the accruing asset value. You can pass it on to your kids or others, and they can continue to defer the tax, and they only pay tax when they take money out. So this is a very resourceful way to create a much more efficient taxable environment when you sell an asset. And there are ways to actually eliminate tax. It's a whole nother conversation, but the moral of the story is, let's make sure you don't just sign a purchase agreement in your name. Now you take the constructive receipt of the income. Let's do some pre-sale planning and look at how we can adjust how this sale is going to go down. And really, it's just a matter of someone else is going to sell this asset, particularly a trust, usually instead of you. and that keeps you from the tax
Gotcha.
bill.
Got it. So is this trust a revocable trust or has this become an irrevocable trust? Because, we've been doing living trusts for 3 decades and basically, that's still the same social security number. So are you talking about putting it in an irrevocable trust with a different tax ID? What kind of trust are you using for this tax planning?
Great question, and I would say it depends. So it depends on how you're structuring the trust and what benefits you want to receive. But sometimes they will be revocable trusts, and you will have a trustee. And that trustee is essentially overseeing that trust, but you control everything in the trust. You could structure it as an irrevocable trust if you want it to be an estate planning play. Right? Obviously, when you're moving into the estate planning realm, there might be benefits to have an irrevocable trust versus a revocable trust. So it really depends on what the goals are of the seller, right? What are they looking to achieve? What is their future income? Like, what do they need? How do they need to integrate this into their estate? So we really, when we're doing that pre-sale conversation, we're taking all those things in consideration, and then we're making the right decisions for them. But Kris, so here's the thing, all of our business comes from financial advisors and tax professionals. Because we don't step on their toes. We don't manage money. We don't tell them how they should invest their money. We don't do bookkeeping. We don't do accounting. We do tax preparation. We don't do tax filing. That's why tax professionals love to bring us in as tax-wise partners. And financial advisors love to do it as well, because we just free up money that their highest income earning clients have that they didn't realize that they had if they were to clip that coupon and clip that coupon.
So what is that coupon called per se for, the.
So there's a few different ones for capital gains, but the one that we like to utilize has been around since 1913.
Okay.
And it's an installment sale. It's a 453, section code 453B.
Okay.
And that's been around since 1913. And, basically when people were selling farms back in the early 1900s, when the IRS, kind of kicked off their thing,
Mm-hmm.
the person buying the farm couldn't pay them the value of the farm. They just didn't have the money, but they paid them under an installment sale.
Mm-hmm.
So really just using the same law that's been in around for over 100 years, and we're just creating an installment sale with this trust. And that's how your client is going to take money out of that trust via the installment note that they control, but to a certain point.
Okay, but this trust is say they did a revocable trust, but then they get a tax ID for that trust because it's different, or they could do it in their own. Say they already have a living trust, can they do it with trusts that they have?
This is a very specific structure.
Okay.
So we're not going to say that the attorneys that I work with that do this have been doing it for 30 years. So they've got lots of experience, thousands and thousands of people that they've done it with. But there is somewhat of a proprietary mechanism of putting it together in a compliant way. So I wouldn't recommend someone to say, great, I'm going to put my asset into my living trust, and I wouldn't recommend that, because it might turn out not too good. So, or the worst case scenario is you're just paying the taxes you would have paid, but you thought you were getting to have some kind of benefit. So, with that being said, it is a specifically structured trust, and then of course, depending on if it's irrevocable, revocable, how we're setting up a third-party intermediary, because that's really important, who the trustees are going to be, that is really the settler. And that really depends on everybody's specific situation, right? Obviously, some of them might look fairly similar, but we always look at everyone's specific situation.
And then is that a benefit? Say, people that are say high end, that'd be great. But maybe somebody's got a property that's not big value, maybe 100,000, but they're going to sell it. Is it worth it for someone with that kind of an asset to pay attention to this, or is it more for over a certain amount of money?
Yeah, Yeah, I always like to say that when you pencil it out, right? Because you got to do the math on it, and
Yeah,
this, very well, right? What does the
hmm
math look like? Right? I like the concept, but what does the math look like? Because there's
exactly.
expenses, right?
Right.
I'm deferring tax, saving tax, but what are the expenses? Because if my expenses are just about as much as the tax, why am I going to do it?
hmm Right.
So we have to take that into consideration. But I will say this. With this capital gain deferral opportunity, it's a time value of money play because essentially you are paying tax. It's just that you control it a lot more efficiently.
hmm
Um, I usually say if you're going to be stroking a check for $100,000 or more, that's your tax bill. Then it starts to pencil out pretty good. If you're paying less than $100,000 of long-term capital gains tax, it starts to get a little less and less viable, right? Maybe $80,000, it still makes sense for some people. But again, the question is, do they want to go through this extra sophistication for less savings,
Right.
right? So I'd say 100 grand or more is the tax. That's the check they're going to write.
hmm
That's where it starts penciling out. And people are like, yeah, this makes total sense. All right. And it also makes dollars. So I'd like
Cool.
to do it.
Yeah. Lots of neat things here. Well, you have a background of leadership in the Marines, and I'm just curious of how your military experience influenced your approach to helping businesses, because I know everything, works together and optimize their tax strategies and financial management.
I love it. I spent some time in the United States Marine Corps. Um, Funny, if anybody that's a Marine out there, um, I was what they call a weekend warrior, right? Meaning I was a reservist.
Okay.
So in the Marine Corps, everybody goes to the same boot camp. They go to the same combat training. They go through the same job school. So for the first 6 months, everybody's equal. But then when you're done with your Marine Corps training, like for your basic job responsibilities, the active duties go to Camp Pendleton or Lejeune or some base, and they have to do it. They have to play Marine every day. And the
Mhm.
reservists go home and they check into the reserve unit,
Okay.
2 or 3 days a month, and they go, play games 2.5 weeks a year in their annual training. So I always used to tell the active Marines that used to kind of poke at us like, hey, you're just a weekend warrior. And I say, well, you can call me whatever you want, but you can call me at home on Tuesday.
Right. Right.
But
Right.
but with that being said, to answer your question, I'll digress to here. It taught me so much discipline. It
Right.
also taught me how to be resourceful. That's the key. Like being resourceful is the key. And really, when it comes to tax planning, you got to be resourceful because essentially the tax liability adds up. Whenever you're paying 25, 30, 35, 40, 45 for our lovely California citizens that do really well,
hmm
over 50% of your profit to the government, that's like a business partner. Well, 50% of my profit's going to a business partner that I didn't really sign a agreement with. That's when you got to be resourceful. So that's when you go looking, and that's what I did. I said there's 75,000 pages of code out there, and there's a lot of different groups and vendors and business strategists and attorney groups that offer this and offer that, and they focus on this tax code and when I say coupons, I'm just talking about codes.
mm
This coupon is application of this tax code. This coupon is application of that tax code. So that's really what it taught me, to be disciplined and resourceful. And I think that has
Resourceful.
played through
Right.
in everything that I've done, particularly this as well.
Resourceful. Yeah. Well, for the listeners that are just starting out their journey, and what kind of tax deductions should they be aware of from day one to set themselves up for success in the long run?
First thing we want to do is make sure that you're properly structured, not only to take optimal use of your deductions, but also to have asset protection, right? A lot of people operate as sole proprietors, and I think that it's wise to go ahead and get an entity structure in place. If you're legitimately doing business, don't get an entity structure before you're doing business, but if you're legitimately doing business, put a structure around it and just make sure that you're keeping all your receipts. You're taking
Right.
you're not missing any expenses. And then of course, let's start climbing the ladder. Should I be an S corp versus an LLC? Can I take the Augusta rule? Can I actually reduce my salary but have more profit above my salary so I reduce my employment tax? should I start buying solar? Should I make charitable donations that are profitable? How, should I be doing some reinsurance of my company because now I'm got a lot of insurance risk, a lot of risk that my general liability coverage isn't covering. So maybe I should do an 831B plan, which is another coupon, right? So there's a lot of different things they should be doing, but climb that ladder. Start with the small and just climb as they build.
Right. Great. Mark, there's 75,000 pages. There's definitely lots of coupons in there if you know how to follow a map and get inside of there. One final note for everybody. Just leave everybody with a cherry on top for today.
Okay, here's the cherry on top. For those that are intrigued about solar, what if I told you that if you purchase solar to reduce your tax liability and to take the federal government on their desire for you, the private sector, to increase the renewable energy grid, make the world a greener place? What if I told you that if you wanted to purchase more solar than you needed to offset your 2024 tax liability, well, you could have excess tax credit? And what if I told you that the Inflation Reduction Act that the Congress passed in 2022 said that if you have extra tax credit that you couldn't use in 2024, you can carry it backwards to 2021. You get a refund for federal tax you paid in 2021. What if you could buy a $1 of tax refund for 50 cents? Well, how many dollar refunds will you buy for 50 cents? And that is the nugget for the day to end this, which is solar gives you the opportunity to get refunds up to 3 years in the past.
Interesting. Well, tell everybody how they can get in contact with you and find out more.
Just go to taxwisepartners.com, and literally we have links on that site that you can, I want to look at some case studies before I talk to you. Or you can literally click a link and say, I'd like to do a 20-minute complimentary consultation, and you can book something right on our calendars. So that would be taxwisepartners.com. And we love to help.
All right, Mark. It's been an honor to talk to you today and find out all these secrets and ways that people can save more money, healthy money, happy life. Thank you so much for being here.
Thank you for having me, Kris. It's been a blast. I appreciate it.
All right. That wraps up another insightful episode of Money 911. We hope you found today's discussion with Mark Myers enlightening and empowering. Remember, when it comes to taxes and finances, knowledge is your greatest asset. Stay tuned for more transformational insights to help you thrive in this ever-evolving financial landscape. Until next time, take care and keep pursuing your financial goals with confidence. There's so much to learn about healthy money. I hope today's discussion brings you one step closer to securing and protecting your future. So you can get started on the right foot, go to meetwithkrismiller.com and schedule your free financial fitness strategy session. Thank you for listening, and please subscribe to Money 911 so you don't miss our next episode, which includes health, wealth, and peace of mind. The power of purpose. Doing well by doing good. The power of purpose. Doing well by doing good. The power to bless lives